Shout out to OM, welcome to MMO Gang. He made around £79 from trading and even went out his way to show us proof. Check it out.
Here we have one big win. Well, not big, but yeah, the biggest win. £80 from a Tesla trade. And then we have this win and that win. So 2 wins, 6 losses. But because we have really good risk reward management, we still managed to make £79 just from these 2 wins, although we had 6 losses.
Hey, it's Pokebanks, baby. Today we're going to talk about debt. And now debt is a touchy topic for a lot of people. A lot of people are in debt. A lot of people use debt to make money. There's 2 types of people in this world. And a lot of people will not talk to you about debt. So maybe school, they don't talk about debt for sure. And then your parents as well, which is a shame. And debt is such a powerful tool, it can fix your life completely. The fact that everyone has to go through debt, so student loan debt or mortgage or car loan, we go through all these types of debt, yet we're not taught it in school, which I find very, very confusing. Hey, but look, if school's not going to teach you, I might as well. Now, the average adult is in £30,575 worth of debt. Now, everyone likes to talk about debt in a condescending manner. Today, I'm here to dispel those myths and tell you what it really is. Now, in this video, I'm going to teach you what debt is, all the types of debt, good debt and bad debt, which debt should you use, which debt should you run from, how to use debt to your advantage. Now, debt is seen as a double-edged sword. There's 2 types of people in this world, one that knows how to use debt and the other one that doesn't know how to use debt. I would like to say that this video is going to go into some sensitive topics, therefore this is only for entertainment purposes only. I'm not a financial advisor, go seek some advice if you need some. Okay, so debt essentially runs our economy. Everyone's in debt to everyone. The UK government's in debt, the US is in debt to China. Most, if not all, companies are in some sort of debt. Everyone has recently graduated from universities in debt. Most people are in debt, even me, and it runs the world. Now you're probably thinking, what is debt? Debt is money borrowed by one party from another to make a large purchase where in normal circumstances they couldn't afford it, which is then paid back with interest. Now, an example of a debt you would take out is student loan. A lot of people can't afford the £9,250 per year, so we get a loan from the government to pay for that. Or a house, for example. Houses can cost from 200k upwards, and it's very, very unlikely that people will have 200k sitting in their bank account, so they cut it up into a mortgage and split into monthly payments. And now, what debt has done is that it's simply stimulated the economy. We can now buy things that we couldn't get our hands on before. Brand new Mercedes? Easy, let me finance that. Holiday to Dubai? Yeah, I can finance that. Brand new clothes? Yeah, I'll finance that. We can call this instant gratification. So essentially, we are receiving the benefit for things that we can't afford now, and we pay for it later. Which has single-handedly helped to drive a consumerism culture. People are buying stuff that they don't need to impress people that they don't like. Okay, so there's 2 types of debt. Secured debt and unsecured debt. Secured debt is simply any debt backed by an asset for collateral purposes. In order to receive this debt, a credit check is done to check the creditworthiness. Now, with the asset that is backing the debt, this is now pledged to the lender in the event that the borrower does not repay the loan. And now, if it's not repaid, then the lender has the option to seize the asset or recoup it. Now, with the asset in secured debt, you never really fully own it until you've fully paid off the loan. The part of the asset that you own is called equity, and the part that you still have to pay off is called debt. Since the debt is backed by an asset, the interest rate for these loans are typically smaller, as if you, the borrower, does not pay back the loan, they can take the asset from you, seize the asset from you, and then sell it to recoup the funds. Now, an example of a secured debt is a mortgage. So essentially, they give you a loan to buy this house. The loan is now backed by the house, so the bank actually owns your house, not you. The mortgage, so the amount of money you own to the bank, that part of the house, they own it. Whereas the down payment that you put on the property, that's the equity, that's how much you own. So like I said, you don't actually own your house until you fully paid off the loan. Until then, the bank still owns a bit of your house, or the lender. Now, if you were to stop making mortgage payments, the bank can foreclose on your home. Similar with a car, so you go finance a Mercedes, the lender owns a part of your Mercedes until you've paid it off fully. And if you don't pay it all off, they can seize your car and then sell it to make the money back since you didn't pay them back. Now, let's look at unsecured debt. This is debt that is not backed by an asset, so they can't claim any assets in the event that you don't pay off the loan. The worst that they can do to you is simply to get a debt collector to come to your house or to report to your credit bureaus. Now, as there's no asset to back this loan, this is simply based on credit worthiness, your ability to repay it back. Now, as this is riskier for the lender, they'll raise the interest rates for the loan to make this a worthwhile deal for them. Now, examples of this are credit cards, payday loans, student loans, and overdraft. This is simply money you can access without giving up any sort of collateral asset. Okay, now you may be thinking, Poku, I'm a little bit confused. Should I get into debt or not? Now, let me tell you something. There's 2 types of debt, good debt and bad debt. Now let me explain to you what they are and how to use them. Now with good debt, this is simply any sort of debt that helps to increase your net worth or has some sort of future economic benefit. Now the type of people that use good debt have these characteristics. They have a clear and specific reason for getting into debt. They have a realistic plan and they know what they're going to do with the debt. They will follow through and make sure that they can afford the repayments. And finally, they do a lot of shopping around, so they go compare interest rates from interest rates to find the cheapest option for them. Now let me give you some examples of good debt. And the first example is a mortgage. Firstly, everyone needs a shelter, so you're taking out debt to make sure you're safe. Now secondly, you're working a 9 to 5 job, so you have regular income coming in. This means you can afford to make the mortgage payments every month. And finally, houses tend to double in price every 7 to 10 years. So let's say when you got the mortgage originally, the house was worth 300k. After the 15 years of paying off that mortgage, it's now worth around 600k. Now another example of good debt is student loan. Now not only are you getting intellect from going to university, now the degree that you get from university will give you future economic value. It will open you up to many jobs which will give you a higher wage. And another example of good debt is a business loan. If you don't have enough money to start your business but you have a well thought out business plan, the bank will offer you money. You can use the money that they're giving you for the loan to start your business, and eventually you'll make way more profit with the loan. The future economic value that it's given you is more profits. Now bad debt is essentially anything that decreases in value or costs you way more than advertised to own it. And the consumer characteristics of people that get into bad debt consist of no well thought out plan to repay. Now examples of bad debt include credit card interest. This is when people put purchases on credit cards and they fail to meet the repayment date. And as a result of that, they have to pay interest. Auto loans, so essentially this is when you're financing a car. Now cars in general, unless it's a collectible or it's a vintage car, they depreciate the minute you drive them off the lot. Now essentially, as you drive the car and it gains more wear and tear, the value of the asset is going down. Yet you're now making monthly payments on a car with higher interest rates. So for example, let's say a car costs 30k. Since you're not buying it outright and you're financing it, you'll probably pay 34k overall. Now the problem is, when you bought the car, it was now worth 30k. You've now paid 34k because that's the interest, 4k interest. And now when you sell it, it's now worth 15k. So now the cost of ownership is around £19,000. The cost of ownership would have been £15,000 if you bought it outright, but since you financed it, it's now even more. So like I said in the definition, it costs you more than advertised to own it. It costs 30k, but you've now paid 34k and now lost out on £19,000. Now another bad debt is simply just consumer debt in general. So for example, when people finance clothes, or when people finance holidays, or even watches. Now all these purchases are items that you don't really need. They are luxuries and wants, not needs. And usually once you're done with them, you have nothing to show off them. I made a TikTok video explaining which debts you shouldn't go into. 4 things that you should never go into debt for. Number 1, weddings. Look, there's nothing wrong with having a small wedding, and 50% of marriages end in divorce. Number 2, any sort of luxury watch. Look, if you can't afford the Rolex outright, then you don't deserve one. Number 3, holidays. How are you still paying off a holiday that you went on 6 months ago? Do better, man. Number 4, clothes. Look, to be honest, if you have to finance clothes, then you already have a problem. Now one thing I would like to add on to that is that if you're experienced in buying and reselling watches, then fair enough, go use debt to your advantage. Now after all of that, you're probably thinking, Poku, how much debt should I really get into? Let me explain. Now enter the debt to income ratio. Now this is essentially the amount of monthly payments that you make in relation to how much monthly gross income that you have coming in. Now the debt to income ratio essentially paints a picture for lenders to see how much you can afford. Now essentially, first things first, you need to add up all of the debts that you make on a monthly basis. So this can be car finance, mortgage, rent payments, child support, student loan, or credit card interest. Secondly, add up all of your monthly income, so everything you own, all your side hustles, whatever. Now you get all of your debt divided by income times by 100, and you get your debt to income ratio. Now let's say all of your debt payments are £2,000, your income is £4,000 monthly, so 2,000 divided by 4,000 is 0.5. Times by 100 is 50, which is 50%. So your debt to income ratio will be 50%. Now, is 50% a good debt to income ratio? This means that 50% of your income is going straight towards debt, which can show that you're over leveraged, and this is high for lenders. Now generally speaking, the lower the ratio, the better. 20 to 30% debt to income ratio is seen as good by lenders. 20 to 30% debt to income ratio is seen as low risk by lenders. You'll be offered more competitive rates with this type of debt to income ratio. Now anything above 50% debt to income ratio will have lenders very cautious of lending to you. This shows that you're over leveraged and you're strapped for cash. In English, lenders just think you're too risky to loan to. Now if someone does loan to you with a 50% debt to income ratio, then that means they'll probably give you some high interest rates to cover up for the risk. Okay, so now let me give you my final words on debt. This is a very serious topic. I'm pretty sure you've heard plenty of stories of people going into debt. This is not a joke to be played with. The fact that you got to this point in the video shows you're more financially literate than most adults in the UK, believe it or not. Now hopefully, with the wisdom I'm giving you, you'll use it wisely and not get into any sort of bad debt. And the worst thing is, school just never teach you this. I'm pretty sure if a lot more people saw this video, there'll be in less financial stress. Now promise me, make sure you stay away from payday loans. This is the worst type of debt to get into. Now the point of a payday loan is simply for people to pay bills or pay for any sort of emergency that's come up unforeseen. But the problem is that their payday hasn't arrived yet, so they need the money quickly. They get the money from the payday loan company and then pay it back once their payday arrives. But the problem is, if you don't pay his loan off within a month or so, the interest rate will skyrocket to around 400%, which is just outrageous. Bear in mind that 100% is double of your money. 400% is 5 times your money. So if you used to loan £100 from one of these payday loan companies, you have to pay £500 back if you held the loan for a year. These companies are the most evil companies in the world, whatever you do, stay away from them. But look, I'm not a financial advisor, this is just for entertainment purposes only. Now I hope this video helped you a lot. Share it to a friend that doesn't know anything about debt. Use it to your advantage. But yeah man, I hope you liked that man. It's Pokey Banks baby.